What's up, guys? In today's video, we are going to be talking about my thoughts on the stock market for the rest of the year. When will this rally end, or will this rally just keep ripping until the end of the year? Let's get into it. So first off, starting with the S&P 500, we've been in this wedge pattern for a while now. And even myself, I've seen a couple of these breakdown tests and I've traded puts on them. Sometimes it actually worked out. Like I was able to catch a couple of these small gap downs on like 1 or 2 week out puts. And then other times, like over here, we just kind of rip and then go right back up. So it's really starting to get to the point where we're seeing this market continue higher. And at least from a technical standpoint, I think until you see a clear trend shift, which means a lower high and lower lows and a breakdown from this pattern, you can just kind of like, it is possible that, we just bring these two lines together and then they get all the way narrowed in, and then you just go to the absolute top of the wedge. It's even possible you break the wedge to the upside. There are a lot of factors in play. We've been continuing to develop classic bearish divergence, especially on the RSI. And that's something to note, that the higher we go, the RSI is not also showing that strength. And I'm not much of somebody who charts the RSI, but potentially soon, if you were to use technical analysis on it, you could kind of see that you're really getting tight here on the RSI, and there could be a point where you get this sharp move. Personally, I think that would probably come around news, maybe something to do with the Fed. If we look into a couple of sources, is CNBC first, it's pretty much likely that, in the second half of the year is when we're going to start to see those rate cuts. And of course, the Fed is really looking for that 2% target level for inflation. So let's see. Despite hotter than expected inflation data, the central bank is likely to start reducing borrowing costs by the end of June with cumulative cuts of 0.75 percentage points or 1 point in 2024. So we're looking into the end of the year for these cuts. I mean, if we take a look at CPI, even without them, we've already seen inflation start to heavily cool here. Of course, they want to see 2% in a variety of other things. So that's really something I'm sure most people are basing a lot of things around. If we go over to larger timeframes here on the S&P 500, you are overbought on the RSI. The last time you were overbought was right before the COVID crash. The time before that you were overbought was right before this drop. And that really wasn't much. You got a typical correction about 10% to the downside. Even on this drop, which was larger, about 20%, you didn't even have an overbought RSI. So that's not something I'm worried too much about. If we look at the weekly time frame here, the one thing we really haven't seen, apart from this week over here, which was kind of just the first week of the year, there could have been people moving around their portfolios for tax reasons. We haven't seen even one large red candle, like, not even a 3-4% candle to the downside. That is another sign in which when you first see that drop, that means something in the formula has changed. That's another thing to look out for. Even if we go over to a monthly time frame, you haven't even seen one red month since October. And then the seasonality towards October, November, right before that Santa Claus rally, especially in September, which I believe is when this was really taking place. September is historically one of not the best months for the market, seasonality-wise. Things are changing, reports from businesses, people going back to school. But you've just seen just nonstop upside recently. If we look at the QQQ, it's pretty much the same exact story. You kind of have a pretty good chance of getting classic bearish divergence on this RSI, so that's something to note. But technically, these things are okay. One part of the market that still has yet to reach new all-time highs and kind of see a steady uptrend is the small caps, the Russell 2000. I mean, you see this chart right here. Everything we've seen really since the end of 2022 looks very white coffee and a very classic setup I've talked about many times on my streams. And you can see that it looks like finally you're going for the breakout here. And again, that also plays into the whole entire interest rate cut idea. I mean, especially for a lot of these companies that are smaller and need to borrow money because maybe they're not really producing the revenues they want yet, having lower interest rates would help out a lot. And I don't think it's too much of a coincidence that just a few months before we're expected to start seeing those rate cuts, you're finally getting a breakout on the Russell 2000. The other part to this that I don't think a lot of people are talking about is how AI will also start to trickle down into these smaller companies and hopefully help them increase things like production levels. And I know there's a lot of debates about this, but maybe even helping to decrease, this is going to be a little bit controversial, but decrease the amount of money that companies are spending on labor because they're going to be able to have AI do a lot of that work for them. And this is really one of the things about the market here and why there is maybe a part of this, especially with the chips that relate to the dot-com bubble. We're just looking at Investopedia here. And if we take a look at this, we had the technology stocks going up. And then if we talk about what happened with the 2000 market crash, you see that a lot of these companies that were tech companies that were, really new IPOs, and they just put .com at the end of their businesses and had a website and all of that type of stuff. They were selling a dream, and they just were not the actual company that they were promising to be or hoping to be. They weren't getting the revenues. They lost capital, and a lot of them really went down. And that's what brought up the market for a large reason. What's different now is a lot of these companies that are bringing up the S&P 500 and the QQQ, they're not new companies. We're talking about names like NVIDIA and Microsoft and Google. They're companies that are already insanely huge, and they're just transitioning parts of their business over into AI, right? So even if that AI were to somehow be a bubble, that would only be a part of their business. They still have their core business. NVIDIA still is making chips and hardware. Google still is a search engine. They still own YouTube. They're still in media. Right? Microsoft still has so much software. They still have gaming. Like, there's so many different parts of these companies. They're not completely reliant, even though, yes, a large part of it has been based upon that. So you have to understand that, I'm not thinking we're going to see any sort of dot-com crash at that same wedge we just looked at on the S&P 500. I think when that breaks down, you'll finally start to see that, maybe, especially on some of these companies. And surprisingly, NVIDIA was kind of the outlier because they had an amazing Q4 report last year. But a lot of these companies, their revenues might not be matching how much their stock prices have gone up just because they're mentioning AI on their calls 30 times. Now, the final piece I want to mention, and this is a report from Morgan Stanley, is that we are in an election year, right? And the average return for election years are 11%. This is leading up until 2016. And I actually don't want to include the 2020 elections because we also had everything with COVID happening. So that kind of was pretty skewed. But if we look at this, 15% average term when a Republican was elected, 7% when a Democrat was elected. So we can see that in general, the market, is poised for this as well. So we have this mixture of potentially statistically really good things. You have the rate cuts coming in. Inflation has already been cooling by itself. Election year. We have this new momentum in the market coming in from AI. We finally have the small caps catching up. Even if we were to start seeing a pullback in the S&P and the Q just because maybe they're overbought, you can definitely see that trickle down into value stocks, maybe mid-cap growth stocks, small caps. There's other parts of the market. And even if we're just talking about speculation, crypto is a perfect example of that as well. You're seeing Bitcoin at all-time highs. You're seeing even smaller coins from a couple years ago really break out and become these new staple names like Solana. You're seeing potentially what we saw in 2021 with NFTs reformat into meme coins on Solana. You're seeing that the speculation is back. If we look into the real estate market, which I'm not an expert on by any means, we have seen a little bit of slower growth in terms of sales over the past few quarters. But again, if we see those interest rate cuts directly, that's going to be affecting mortgages, and that can also help lift that up. So overall, if we're putting all of this together, the formula is still good for the market. It's weird to see the S&P in this wedge because that's what happens when you go up so much for so long. And until we continue to, or unless we can't continue to see that type of performance and the trend changes, formula is still the same. So just keep these 4 parts of the formulas I just mentioned. I do like this article from Stanford University where they just kind of mentioned a few other things that could affect things. I'm literally just going to read the titles here just to give you some things to think about. But before we go into this, I want you to take a look at the sponsor of today's video, Public. Public recently launched options trading on their platform. It is easy to sign up, and trading options on Public is commission-free. There are no per-contract fees. They have an options hub where you can explore actively traded options and so much more. What makes Public different is that they're actually sharing 50% of their options revenue with you, meaning you get an 18-cent rebate back for each contract you trade. This 18 cents is expiring March 31st. So make sure you sign up by clicking the link in the video description and activating options trading on Public before March 31st, 2024 to lock in your lifetime rebate. Now back to the video. Okay, so here are the 7 things just to keep your eye on. First of all, the consumer disconnect in an election year. That's number 1. Number two is going to be COVID-19's lingering labor effects. This also leads into, I think, the fourth point, work from home. How will that continue to unfold? The third point, Congress's fiscal cliff problem, right? If we take a look at tax rates, if we take a look at the federal debt, how will that continue to build? That's more of a long-term thing, however. The need for treasury market reforms, all right? And then the beginning of the end for non-competes. We're looking at a lot of these large companies, a lot of these antitrust laws. How will that continue to unfold? California, what's going on there? And those are just 7 things, the thought provokers to keep your eye on. Moving on, we also have this BlackRock student of the market slideshow. And let's go over here, just breaking down some of the analysis for the market. Positive January and February. You can see over here, average return following January and February. You can see 2024, January 1.7% and 5.3%, right? So you can see only two of the last 34 years that started with a positive January and February, ended the year negative. So that's a very strong signal to start the year. And we're about to look into this JP Morgan research heading into the year. And they actually were pretty bearish on the market, and they were wrong about their outlook going into the year. And we're going to talk about just why so they were wrong. But you can see BlackRock here, waited a couple months to put this out. I'm sure they also had an outlook prior to the beginning of the year. But you can see that since BlackRock has kind of taken a look at this, you can see that everything is kind of putting a picture together. Stock volatility has remained low. Lower volatility has typically resulted in much stronger returns. And then we're going to be talking about the rate cuts again, right? The chance of a recession, which is something that we're going to talk about in the JP Morgan article as well. But stocks have benefited when rate cuts don't cause a recession in the following 12 months. So if we take a look at this historically, this goes from 1984. You can see the chart right here, Fed rate cut and no recession in the next 12 months. You can see these 4 instances. And then you can see Fed rate cut and recession in the next 12 months. 2001, 2007, 2019. Those were both 3 before pretty decent drops in the market right there, right? And then another thing, we're consistently seeing these new all-time highs, and that's typically good. When you make a new S&P all-time high, most of the time that does help out the market, and you don't just like tap an all-time high and then dump. Like usually you see a continuation of that. So, we talked about the treasury markets briefly earlier. You can see that mutual funds and ETFs, as well as bonds, are something that they're focusing on. And you can see over here, money market funds, which were a lot more popular, did not really perform as well as the bonds over here. So interesting to take a look at all of this, and you can just see how they're also putting together that picture towards the end of the year. But if we look back heading into this year, JP Morgan put out their outlook, slow global growth clouds forecast for equity, some of the things they were thinking about. And they thought heading into this year, growth is poised to slow as positive shocks phase with rising yields and tighter credit bite. Inflation moderation is expected to be limited by lingering damage to supply and a shift in inflation. Pressure will likely be concentrated in business sectors where margins should compress. Inflation will not fall to a target that the Fed was looking at. U.S. supply side performance has been impressive this year, but you also have the easing labor markets despite strong growth. So you can see that they're looking at this overall view, and they're even looking at China and Europe domestic demand shortfalls over there. And a lot of the things that they were saying, even if we go back over here, some of their key takeaways, they really think that this inflation is not going to get down to that target rate. And they're also talking about, I think, let's see if I can find where it said 2025, maybe somewhere over here. They're expecting the end of this global expansion by mid-2025. So they're thinking that 2024 is kind of the last leg of that rally. They're still seeing potentially, an uptrend in the market this year with an earnings growth of 2 to 3%. But the price target was 4,200. And, we're seeing a lot more than what JP Morgan was thinking. And they just I think they were trying to be a little bit too risk off heading to the year. Maybe that's bitten them a little bit. I'm sure they're still doing a great job. They're even looking into emerging markets. They thought there was going to be a bumpy start to the year, and then later on in the year, see more traction over there. So that is something to still keep an eye on. Even with China, it lagged quite a bit in 2023, and they're thinking it could be a slightly better year heading into next year. So these are some of the other things. I just want to leave all of you with this type of stuff to think about. Even though we did see a very aggressive start to the year, some of these points still could remain true heading into the end of the year. So there you have it. Those are my thoughts and other people's thoughts, which hopefully are a lot smarter than me, even though they didn't get the first couple months of the year right. And I just want to thank again Public for sponsoring today's video. Make sure you activate and sign up. Well, to sign up and activate your options trading, you have to do it by March 31st. And you can get that lifetime rebate. You can use the link in the video description, public.com/championvibe. This video is going out on Saturday, March 30th. So literally tomorrow is the last day. So make sure you sign up for Public and activate that to get that lifetime rebate. And have a great time. Enjoy your weekend. If you're watching this during the week, I hope you have a great week. And I will see you in the next video.